The empire shattered. Canada's largest dynasty fell into a $1.6 billion financial abyss. How did this happen? The once mighty Reichmann family, known for their vast real estate holdings, pursued reckless expansion amid roaring market euphoria. Their pursuit of prestige projects made them vulnerable. Major banks, once partners in their ambition, began slamming doors on credit. With a surge in interest rates and a slowdown in luxury demand, the consequences struck hard. Thousands of employees faced layoffs, and lives were turned upside down. Early indicators, such as rising vacancy rates, flashed warning lights, but the Reichmanns overlooked them, mistakenly believing they were merely bumps on the road to success. The central decision was clear. They doubled down on high-leverage financing, convinced that the good times would last indefinitely. Their historical achievements bred complacency, clouding their judgment and allowing overconfidence to thrive. As the global economy started to shift, they dismissed signs that suggested a downturn was imminent. The first warning sign went unnoticed while their cash flow began to tighten. Debts mounted and cash reserves dwindled. As the debts proliferated, pressure mounted. The family had to liquidate smaller assets just to keep afloat. They ignored the advice of seasoned financial analysts who warned against their aggressive strategy. Instead, they poured money into risky luxury developments, operating under the delusion that recovery was around the corner. Each decision to chase high-profile projects sapped valuable resources, and as funds evaporated, their situation grew dire. Relationships with investors frayed, trust began to erode, and reputational damage became inevitable. Months passed with little change, unless you counted the growing signs of distress. As major projects faltered, the Reichmanns could no longer meet their financial forecasts. The tipping point arrived, leading to cancellations and defaults that devastated their holdings. Legal repercussions followed swiftly, with investors seeking restitution, further tarnishing the once lauded reputation of the Reichmann family. The fallout was systemic. The institutions that backed their ambitious ventures found themselves entangled in a web of losses. Entire portfolios wiped out highlighted the reckless lending practices that had previously gone unchecked. Regulatory scrutiny intensified across the financial landscape, prompting a reassessment of lending criteria. This crisis stands as a poignant reminder of the consequences of overreaching. The fallout rippled throughout communities, affecting families and workers who had once thrived under the Reichmann's banner. The name once synonymous with success became a symbol of excess and misjudgment. The hard lessons are stark. Diversification and prudent risk management could have shielded the Reichmanns from collapse. The human cost was staggering, a sobering testament to the price of ambition gone awry. Ultimately, accountability took center stage, serving as a warning to future generations about the perils of complacency in an unpredictable market. Trust eroded, and in its place stood the topic of governance, the necessity for balance between ambition and caution, as well as the imperative for financial institutions to maintain stringent oversight. The era of unchecked luxury investments drew to a close, but the lessons lingered on, echoing through the boardrooms and life stories affected by the downfall.